Welcome to Spidell's California Minute. I'm your host, Catherine Zidane. This week, we're covering some of the more common California adjustments to be aware of for individual taxpayers. Spidell's 2024 Trust Webinar Series includes 8 in-depth webinars which will help you build your trust business, prepare trust returns, and earn 17 hours of CPE. Podcast listeners can get 10% off of the full package of 8 live or on-demand webinars using discount code TRUST10 at checkout. The discount is valid October 6th through October 18th. For details, go to caltax.com and click Webinars. In general, California law conforms to the Internal Revenue Code as of January 1st, 2015. However, there are continuing differences between California and federal law. When California conforms to federal tax law changes, California does not always adopt all of the changes made at the federal level, necessitating adjustments to be made on the California return. Here are some of the most common adjustments for individual taxpayers. Being aware of these differences can ensure your clients minimize California tax liabilities and avoid penalties. California did not conform to the suspension of 2% miscellaneous itemized deductions. This means taxpayers can still claim these deductions on the California return, including deductions for unreimbursed employee expenses, casualty losses, investment fees and expenses, and legal expenses. California doesn't have its own version of the federal Form 2106, Employee Business Expenses, so attach a copy of the federal Form 2106 using California amounts for those taxpayers claiming unreimbursed business expenses. California does not conform to the TCJA amendments lowering the acquisition debt limit from $1 million to $750,000 and repealing the deduction for interest on home equity debt for the 2018 through 2025 tax years. This means California taxpayers can claim increased mortgage interest deductions on their California return. California does not conform to the Federal Treatment of Health Savings Accounts, or HSAs. Here are the differences. Contributions are not deductible. Earnings in an HSA are taxable and losses are deductible. And California does not allow a tax-free rollover of an IRA, flexible spending account, or health reimbursement arrangement into an HSA. California does not conform to the TCJA amendments that repeal the deduction for alimony paid and exclude the alimony from the recipient's income, meaning the payer can still deduct the alimony payments, and the payee includes in the income on their California return. Interest paid on U.S. savings bonds, U.S. Treasury bills, or any other bonds or U.S. obligations of the U.S. and its territories, not including Fannie Mae and Ginnie Mae bonds or securities, are taxable on the federal return but not taxable to California. For taxpayers who invest in mutual funds, interest can only be excluded if at least 50% of the assets held by a mutual fund consists of interest-bearing obligations that are tax-free for California purposes. This includes U.S. and California obligations. Conversely, federal law does not tax interest from state or local bonds, whereas interest from out-of-state municipal bonds is taxable to California. This may require an addition adjustment on the California return. Foreign Social Security benefits received by a California resident from the government of a foreign country are generally taxable to California, even if they are tax-exempt or treated as Social Security for federal purposes under a federal treaty. And last, unlike federal law, California taxes California residents on their worldwide income and does not allow a foreign income exclusion. Taxpayers who exclude this income on their federal return will need to make a subtraction adjustment on their federal return. These are just a few of the differences to be aware of when preparing California returns. For a detailed discussion of all of the California adjustments, see Spidell's analysis and explanation of California taxes. You can pre-order a print or online version of the 2025 edition at caltax.com under Publications. That's all for this week. Join us next time for another episode of Spidell's California Minute.